Where does the buck stop? Let's ask Victoria Greene, Squared Private Wealth CIO. Victoria, great to have you with us. How much juice is left in this dollar move, and what does that mean for corporate America?
It's not good. It typically is a big earnings drag. It's important to know where your company's revenues are coming from and how this may affect with currency translation. But look, right now you have a Fed that's going to hike aggressively. They got a green light to go with a good unemployment. You know, we're all watching Wednesday. We'll see what happens with inflation. But right now you kind of have disparity across the world with what the U.S. economy is doing and what's happening in, say, Europe and Japan. And some of that I even put into kind of the commodity makers and the commodity takers, right? So we have companies that are producing oil and gas, and then a lot of pressure on Europe on how they're going to be able to consume and get their oil and gas. So I think the dollar could continue to run. Obviously, it's data dependent, and it's going to be a big headwind because this is a fairly rapid rise in Q2. And, you know, like you said, companies may try to bail out weak earnings anyway and blame the dollar. It's kind of fun. It's like blaming the hedge funds for shorting you if you're not doing well in the market.
Victoria, let's talk more broadly about stocks. Still bearish?
Yes, I think this is more of a dead cat bounce. We'll see what happens Wednesday in earnings season. We are bearish on earnings, winter is coming as kind of our theme here, because I don't think the numbers are going to be great. If you look at the inflationary pressures, the labor pressures, not much happened from Q1, and expectations in this year was that Q2 was going to be the hardest hit earnings, and we might see a second half recovery. So I think we have a lot of headwinds, and then you throw in the dollar on top of all of these other things that companies were facing, and then some commodity price uncertainty. Yes, we saw some input prices come down late June, but for the bulk of Q2, you still saw a lot of high inflationary pressures from metals and oil and gas. So I think it's going to depend on how successful CEOs were navigating, how much contracting and hedging they had, and what they're able to say going forward. You know, guidance is something that we're listening to very carefully. It's almost like data is moving so fast. We're like, oh, we expected a bad Q2, but what about the second half of the year? You know, so I think earnings misses are going to be punished. I think if you beat, you're not necessarily going to be rewarded as much. And we saw some of that in Q1, where a good EPS beat, but maybe a margin miss, then you were punished. Or a good beat and a good margin, but your guidance was slowing, you still got punished. So it's almost like companies can't win right now because of all the worry.
Companies can't win, but when you look across sort of the landscape here, which sectors and industries stand out to you right now as most vulnerable as we look ahead to earnings season?
I think you've got some of this discretionary. Obviously, the consumers had a lot of stress. I know they're starting to add on some debt and go into their credit cards to keep spending a little bit higher. But I think discretionary could certainly be under pressure. Staples, if you saw some increase in cost. But, Costco actually came out, which is a stock we really like, saying, hey, we actually had a pretty decent Q2 on some of our gasoline revenues and other things. So I think you need to think consumer exposed stocks. And then also the technology sector is one, especially the growthy sector or small cap sector, where they're just more aggressive and more levered. We want stocks with show me earnings, right? Show me cash flow now. We want a shower.
Yep.
We don't want one that we're getting promised things in the futures that are future growers and oh, we're going to make you money in the future. We've got all of this innovation. We want stocks that right now show me you make money and you can execute in a tough market.
Are the oil stocks still within that group? Brent, WTI, all over the place. Brent's down 2% today, 104, but we've been sub 100. We've been up into the kind of mid 150 area. Victoria, this is an area that's all over the place as the market tries to figure out where the global economy is going. What impact is that having on your thoughts around oil stocks?
We still like energy stocks. You did notice I left them off my list a little bit earlier. We're a little more neutral short term. You have this battle right now between supply constraints and what's happening in Russia. And then you have potential demand destruction with a recession, which historically isn't great. And there are some ugly charts right now, a lot of comparisons about the 2008. You had the spike in prices up to 150, and then it immediately came down after we hit a major recession. We don't necessarily think that's going to happen. If you look at what oil was was doing pre-Russia. You were already at that $90 a barrel level, which is a great spot for a lot of U.S. producers, especially in the Permian where their break-evens are much, much lower. So I think you could have some near-term headwinds. I think they're going to have a great Q2. You still had them print cash. You haven't seen a ton of CapEx. They're distributing their earnings and cash flow to their shareholders. And so I think you've got a little wild cards, and we're a little worried about what the trajectory is going to be short term. And some of that has to do with is Russia going to cut off all natural gas to Europe, which could cause a massive price. And you look around and you had what JP Morgan at 380 as a tail end risk if Russia fully exits Europe. And then you have, 65 from Citi. So you have this wide dispersion, and it's just going to be data dependent. We tend to think it's going to be a mild recession. So we are holding tight with our oil and gas. We'll clip our dividends. We're getting paid to wait there right now for most of these companies, and paid very handsomely. And we tend to think that $90 to $100 oil is very sustainable. We didn't like oil over 100. That's where all of a sudden you see this demand destruction.